Let's go, baby. Trading NFP. God, let's see how it goes. Let's see how NFP go. Oh my god. Oh my god. Guys, this will either make me a lot of money or I'll lose. Oh my god. Oh my god. Let's go. Man, Forex dog. Shit, I'm going. Oh my god.
Oh, I coming up.
You see, knowledge is power. Like, how do you blow your accounts in one trade? You see, if you had the proper knowledge, that would never happen. So you understand why I do these videos for each and every one of you, so you don't see yourself in that type of situation. Well, this is Walter FX and welcome back to the channel. If you're new here, subscribe to the channel. If you're a returning subscriber, I love that I'm seeing you again. Please pay attention, as today we're going through a very critical topic where I'll be telling you all about pips, lots, spread, and leverages. And leverages. So these are the key things you will use in executing a trade. This is where the money is made. These are the key things you will need to know in executing a trade, so you know exactly how much you're risking and how much you stand to gain, to wipe away fear of missing out and any anxiety from the unknown, like having no knowledge of how much you stand to lose or how much you stand to gain. So stay tuned. So a lot is the minimum quantity of a security that can be traded. Once again, relax, calm down, guys. You will understand once I just get to the example. But that is what a lot is. Now, leverage. Leverage is borrowed money or capital from your broker, which you can use to trade. Yes. So your broker provides you with leverages, which means, like, okay, the most common one is 1 to 100 leverage, which means you can trade 100 times the amount in your account. That's, you have an account of $1,000, you can execute trades up to $100,000 with that your $1,000. Amazing, right? Yeah, that's one of the good things about Forex. Then you also have the 1 to 10 leverages, which some brokers provide, which means you can trade 10 times the amounts that you have in your account. That's, if you have $1,000, you can trade $10,000. So for the 1 to 100, if you have $100, you can equally trade that $10,000, because then now you're using 1 to 100. So that your 100 multiplied by another 100 will give you $10,000. That's if you're using 1 to 100. Okay, let's just put it like this. You want to trade $10,000. If your broker provides 1 to 100 dollars leverage, all you need to trade $10,000 is $100, because you will do 100 times 100, which will give you that $10,000. So your broker is basically borrowing you up to $10,000 to trade with. Then if you have a 1 to 10 leverage and you wish to trade $10,000, you will need an account size of $1,000, because your broker will provide you with 10 times that amount to trade with. Wonderful, right? Let's move on. Spreads is basically how the brokers make their money. Like, that's just how they make their money, because people are always like, oh, okay, this is one of the things that clarifies that it's not gambling. People are like, no, you're just funding the brokers when they lose money because they don't have the proper education. No, the brokers don't make money from your losses. They make money whether you win or lose, and they make it through spreads. Spread is basically the bid price versus the ask price. This is basically them taking a share of your trade. Before you even enter yourself, they will show it to you, because it's going to be there in the line. They will show you the current price, like at which the commodity is. Then if you're buying or selling, you will have the bid price and the asking price. and that is what you enter as. They will first take away a couple of pips as their spread, which is how they make their money. Then you enter at their price and make yours if you're in a winning trade. Okay, now let me give you examples to help you understand the flow of these 4 words I just taught you: a pip, a lot, leverage, and spread. So now this example will show you how they work and help you understand how it's going to be for you to make money when you're executing a trade, and help you understand your risk of going into a trade and how much you stand to gain. Now, ideally, most people will consider that you don't risk more than 1 to 2% of your account when taking a trade. That's because of emotions. You have to be emotionally stable when trading the Forex markets. I mean, money equals survival. They say, the rate person when you get money. So when you're dealing with money, you're most likely to get emotional, especially when you know that, okay, this is how you want to see your daily bread. So that is why most advanced veterans will advise that you use 1 to 2%. So even if your analysis was wrong, you won't feel your account. Like, okay, let's say you have an account of $100, you risk 1 to 2%, that's $1 to $2. Even if you're wrong, you've only lost $1 to $2, you still have $98. So your confidence will not be all that bad. You just, okay, that was one bad trade. I still got thousands to go. Let me just get my analysis better. But let's say you're risking like 50% of your account. You started with $100. That trade goes bad. Now you have just $50. You're panicking. Like, what? Half of my account is gone. Like, what? No, where do I start from? No, you see, that's why most will understand that you have to play the long game, and by doing that, you do it by risking 1 to 2%. The more you risk, the more you stand to gain. But that is not smart practice. Because you're not a robot. Except you have a robot now that can execute everything for you, then fine. But if you're wishing to trade by yourself, you have to manage your risks, therefore managing your emotions. Do you understand? You must manage your risks. You cannot risk more than you can afford to lose. Like, find your trigger points, find your risk appetite. How much can you risk that? Okay, even if I lose this money, it won't faze me. I can still perform proper analysis and make more winning trades and eventually make money at the end of the day before you call it a day and go to bed or whatever activity you want to do for the rest of the day. So let me quickly help you understand how lots work. You have 4 types of lots. Like, basically, you have the nano lots, that's 0.001. Most brokers don't even offer the nano lots. It mostly starts from the micro lots, which is at 0.01. Yes, 0.01. So 0.01 lots means you will make 10 cents for every peep that goes in your direction. Remember what I told you about a peep? A peep is the smallest amount of which a security can move. So for every peep that goes in your direction, you will make 10 cents. Let's say you buy a commodity, then the price goes up by 10 pips. If you're using a micro lot size, that's 0.01, you will make $1. You understand that? If you're using a mini lot, which will be 0.10 lot, that's 0.10 lot, a mini lot. If you were to catch that 10 pips with that lot size, it will be at $1 per peep, which means someone that used a micro lot and cut that 10 pips, making $1, you would make $10. Do you understand it now? So now I'm using a micro lot, you're using a mini lot. So I'm using my micro lot at 0.01. That is what I quoted there. Then we catch 10 pips of a commodity buy. By the time the trade closes, I using a micro lot at 0.01, making 10 cents per pip, will make $1. Then you using a mini lot at 0.10, which is $1 per pip, will make $10. You understand? Then someone else using a standard lot in that same trade, which is 1 lot size, that's the standard lot size. You can use the 10 lot size, but this explanation is just to help you understand how it works, so you know how much you're risking, like as you add the lot sizes. So you're using 1 lot size, someone using standard lot size, 1 lot size, and that's our same trade. He would make $100 because he is making $10 per pip. So for that 10 pips that I make $10 or you make $10 off and I make $1 off, he will be making $100 because he's using a standard lot, which is quoted at $10 per pip. I hope you understand that. Now, let me help you understand how spread works. Spread basically is like, okay, let's say, have you ever gone to the market where you have like middlemen? Your brokers are basically working as middlemen, because it's like, okay, something is also priced, then they're basically adding their own money to it, which is how they will get their profits. Okay, let's say US dollar is at 1.283, and I'm looking to buy that US dollar. The broker can sell it to me at 1.293, adding a 10 pip spread. So they'll tap me in at 1.293. So it means for me to make money off that trade, since I've selected a buy, I have to first cover their spread. Price has to go from that 1.283 where it is past 1.293, which is the price the brokers have given to me so that they can make their own money. You're trying to make money, I'm trying to make money, they are trying to make money. So it's just to help you know that your losses are on you. They don't have anything to do with your losses. Whether you win or not, they still collect their spreads. That's how they make money. No scam anywhere. This is just to help you understand that. You understand? So you say so now they're tapping me at 1.293 when price is currently at 1.283. So price has to go, once price reach 1.293, I haven't made any money. It has moved 10 pips, but I haven't made any money because I just firstly covered the broker spread. But any more movements of price in the upward direction, because we're buying now, like price moves from 1.283 to 1.303, that's 20 pips. I've made, let's say I'm using a standard lot size, which is $10 per pip. I have made $10 for the brokers. Now price moved from 1.283 to 1.303. I've made $10 for the brokers. I made $10 for myself. But let's say price moves from 1.283 to 1.333. Let's just put it as that. I've made $10 still for the brokers. No matter what, it's just that $10 they're going to get. Their spread of 1.283 minus 1.293. Then the rest is for me. So now the price has moved from 1.283 to 1.333. That is, I have made $40 for myself because price have moved 50 pips in my direction. which is a buy direction, and the brokers are taking their spread of 10 pips. They are $10. So the remaining $40 is for me. That is my profit. The brokers have nothing to do with my profits, and they have nothing to do with my losses. So all those people talking about, okay, my brokers are trying to scam me, this, no. So the best advice I can give you is look for a broker with tight spreads, because you always want a good deal. When you go to the market, you always look for the best deal. So all you just have to look for is for a broker with tight spreads that you feel like, okay, I don't mind giving them 10 pips out of my this thing for every trade that I take. So you have to search, do your research. There are a lot of brokers out there. The one you feel that, okay, these have the best spreads, then you can work with them. You understand? And I know you do. My examples go hard. Thank you so much. Thank you so much for listening in this class. It's always a pleasure. Once again, I'm Walter FX. Like the video, subscribe to the channel, and stay tuned as I guide you on your journey into being a profitable trader. Cheers, guys. Cheers.